in local economy, you are still traded with your home currency, but in dollarization, you remove the local currency, you trade with dollars even in your home currency. So the decision to use dollar as a local currency cannot be easily reversed because you no longer has a local currency. So, and then we talk about the single currency, like we see the European currency. Everybody gave up their home currency and then opt a single currency in a zone. So let's talk about this, a single European currency. So in single European currency, what happened? So they established a central bank called European Central Bank, which is responsible for setting the monetary policy for all the European countries. And its objective is to control inflation and stabilize the value of euro. So why they did that? So basically, the selecting euro as a currency for eurozone for European countries is that so they want to eliminate the exchange rate risk among the European countries, and also the goods and the money can easily flow from one country to another, even though they have borders, but the exchange rate risk is completely eliminated because every country is using its currency as euro. So it may be argued that the set of countries with the same currency and monetary policy will have achieved greater economic stability than if the currency had its own currency and monetary policy. So the idea of the Eurozone is just that every European country should be lifted upward rather just wasting times and energies and resources by making monetary policy of their own and stabilizing their own home currency. So why not just go for one currency that is euro for European countries? So what it has impact on the European firms. So prices of the products are now more comparable and stable in European countries. If somebody wants to buy a phone or buy some raw material or some other from the European countries inside, so its prices are more stable, more comparable. So more trade can be among each other rather than going outside of the Europe and giving orders. Why not we, improve the financial and economic condition of our own Eurozone? What it has to do with the financial flows. So bond investors who reside in the Eurozone can invest now in other Eurozone if interest rate higher in, for example, Italy is a part of Euro, right? For example, I just missed that, whether it's a part of Euro or not. Okay, for example, if it's a part of Europe, if Italy increases its interest rate, so Germany can invest in Italy directly without any exchange rate risk. Or if interest rate is higher in Greece or in Cyprus, you can just invest over there or purchase from there, or flow the capital from one state to another, one country to another without any exchange rate risk, right? So basically, financial capital can move freely among the countries without having any exchange rate risk. So exposure of countries within a Eurozone, a single European monetary policy prevents any individual European company from solving local economic problems with its own unique monetary policy. Like we saw what happened to Greece and Cyprus when they are in financial turmoil. So they cannot make their own, financial policies. Why? Because they need to follow the policy of the central bank of European Central Bank. So European Central Bank is not basically devising customized policies for Greece and Cyprus. They have to design policies for all the euro. So in that case, the problem of the Greece becomes worse and worse, and Cyprus as well. So the other countries, they jumped and they try to stabilize the Greece and Cyprus, so that if Greece defaulted or Cyprus defaulted, it will be having an adverse effect on euro, and because everybody is trading in euro in European zone, so it has a direct effect on other countries as well. So that's why everyone rushed to support and stabilize that country. So impact of crisis, it may affect the economic conditions of other participating firms as well, but they all rely on the same currency, because they all rely on the same currency and same monetary policy. So that's why Germany, rushed to support Greece and Cyprus and try to, stabilize that country, because they are following the same currency, euro, and same monetary policy. So reasons for government intervention. Why government intervene in forex exchange rate, foreign exchange currency markets? Number one, smooth change rate movement, so that no single firm, no single country can affect their home currency, or any bad transaction can affect all the value of the home currency or not, right? So this smooth the value of the foreign exchange. Number two, establish implicit exchange rate boundaries. So, for example, it's not written, like you have to, government, your currency is going upward and down, upward and downward for 3% or 4%. No, it can go up. So government can decide their own policy, 8%, 10%, 20%, 1%, 0.5%, depends on country's goal. So implicit, which means unofficial. If they announce that one, then others start doing the same, and which may adversely cost your relationship in terms of trade as well. Respond to temporary disturbances. If there is a temporary devaluation right now, or depreciation, the government intervene, and through direct intervention or indirect intervention, they try to stabilize. We'll talk about what is direct and what is indirect intervention. Here we go. So how central bank can stabilize the the currency market. For example, to force dollar to depreciate, the Fed, which is the Central Bank of America, they can intervene directly by exchanging dollars that it holds as a reserve for other foreign currencies in the exchange market. So in America, if American government wants to decrease the value of dollar, so what happened? So the government will sell its dollar in the market and purchase foreign currencies. So in simple words, the central bank purchase, euro, pounds, yen, yuan. What happened? In that case, government is trading against its home currency. So home currency supply increases, and the demand for foreign currency start rising. In that case, when supply increases, price of the dollar start decreasing. So the Fed desire to strengthen the dollar. So what it does, it sells the pounds or yen, yuan, euro to the market, and for exchange of dollars. In that case, central bank buying the dollars and selling the foreign currencies. Foreign currency supply increases, foreign currency value goes down, and hence dollars start increasing, right? So government can do against one currency as well, and can different currencies as well, right? So effect of central banks intervention in foreign markets. So what happened? So this is basically the market for pound, and government wants to decrease the value of pound. How it decreases the value of pound? So you are in US and government wants to decrease the value of pound. How it can do that? So it take out reserve from its central from the World Bank or the reserve it already hold, and it sell the dollar, sell the pound, and purchase the dollar. So to weaken the pound, the Fed exchanges pound for dollars, which causes outward shift in the supply of pound for sale in the foreign exchange market. So in that case, supply shift to the right. Supply shift to the right, we have a new equilibrium here. You see, quantity increases, price decreases, right? And also, if they want to increase the value of pound, appreciate the pound, or it means they want to weaken their home currency against pound. So in the market of pound, what they try to do, they buy the pounds. When they buy the pounds, buyer creates demand. So they buy the pounds, demand shift to the right. In that case, those who are holding the pound, they will sell their pounds to the government. And what happened? In that case, quantity of pound increases, also price of pound increase. Price of pound means exchange rate of pound start increasing, right? So by flooding the market with dollars in this manner, the Fed puts downward pressure on dollars, right? Because seller creates supply, buyer creates demand. So in order to strengthen the pound, so this is the explanation of here, by strengthening the value of pound, what they are doing, they will buy the pounds. When they buy the pounds, they will trade against dollars. So they supply, so whoever owns is a seller. So country owns dollar, so they supply the dollars. So country want to purchase purchase pound. So this is the market for pound. Not we are not talking about pound here, dollar here. So pound, we want to buy. Government want to buy pound. Pound demand exploded, and the price of the pound start increasing. This is direct intervention, right? So for direct intervention, you must rely on your reserve. The country must have extra reserves of the foreign currency, right? So intervention either can be non-sterilized or can be sterilized. Let's just talk about this. What is non-sterilized or sterilized? So this is a part of direct intervention, either through sterilized or through non-sterilized. So when the Fed intervenes in the foreign exchange market without the changes in supply, money supply, it engages in non-sterilized intervention. In sterilized intervention, if the Fed intervenes in the foreign exchange market and simultaneously having an offset position in treasury securities, then it is called sterilized. What does it mean? This is sterilized and non-sterilized. So if government wants to strengthen the value of Canadian dollar, right? Which means if government wants to strengthen the value of Canadian dollar, it means they want to weaken the dollar position. So what it can do? From foreign reserve, they will, if they want to increase the value of Canadian dollar, they will increase their foreign currency reserve of Canadian dollar. They will purchase Canadian dollar. So Canadian dollar will go to the central bank, and central bank releases or flooded the dollars in the market. So this is called non-sterilized because you don't have any backup for to stabilize this one. In that case, when countries having so much dollars, in that case, inflation starts rising, right? In order to cope up with the inflation, governments issue, government has to take two actions. One is